This is WPSL Port Saint Lucie, the talk of the Treasure Coast.
It's 11:07 at WPSL 1590, the talk of the Treasure Coast. And you're on with the folks from Sun Palm Financial, and that is Sandra Liliana and Dave Thomas. Good morning.
Hey, good morning. Welcome to the Sun Palm Financial broadcast, where we talk all things money. I'm your host, Dee Thomas. My clients and friends call me Dave. I'm here with my co-host, Sandra Liliana, and we're broadcasting live from the Treasure Coast of Florida, and we're heard worldwide on Alexa, Google Home, and the TuneIn app.
Today's topic, we are going to talk about the condition of the U.S. banks and concerns about an upcoming commercial real estate collapse due to the work from home effect from COVID. We want to know what you think. Call us at 772-340-1590. That is 772-340-1590. Now, before getting started, I wanted to advise that we may be making some financial suggestions in the broadcast. So a quick disclaimer. The information and opinions contained in this broadcast have been obtained from sources believed to be reliable. They are given for informational purposes only. The information is not intended to be used as the sole basis for financial decisions or as a solicitation to sell.
All right, so on for the topic today. So this is a part two. Last week, we started on this topic, and we had a lot of calls coming in. The phones were just kind of blowing up. People were really engaged in this topic, so we basically ran out of time and had to move this into a part two. So, of course, condition of the U.S. banks, the concerns for an upcoming collapse that may happen, 08 style collapse. But this one's going to be a little bit different. It's not going to be based on the residential real estate, but potentially the commercial real estate. And we're going to talk about that in a little more detail. Part of that is due to what's being referred to as the COVID effect. So essentially the concern is that because so many people are now working from home, they're not coming back into the workplace, we have all this commercial real estate that's just sitting out there empty. And people have started to come back to work, and some companies have started to force them to come back to work. Others have just said, you know what, if we can operate the way that we've been doing through COVID, then we don't have to pay these big leases. So there's a lot of interesting nuances happening here. Now, to recap from last week, since this is a part two, we talked about the condition of the U.S. banks. One of the things we highlighted was, of course, 2023. Now, 2023, there were 5 major bank collapses. So we had Citizens Bank, Sac City, Iowa. We had Heartland Tri-State Bank in Elkhart, Kansas. We had First Republic Bank, which was a good-sized bank there in San Francisco, Signature Bank in New York, and Silicon Valley Bank over in Santa Clara, California. Now, that one got the most publicity, was the Silicon Valley Bank. These guys were known for essentially, starting up a lot of the tech companies. So they were giving loans, these tech companies, getting them off the ground. They were very intricate in that business sector. So for that bank to have gone under, it caused just this ripple effect that really came through. And these banks did not stop here. There were some that continued struggling, and they're teetering even now into 2024. So definitely a concern to look at. But as we talked last week, was it a situation where we're going to automatically just go right into a 2008 situation? And the consensus was no, at least not yet. Back in 08, we highlighted that there were over 100 banks that went, and then in the following years, I think it was 157 in 09 that collapsed and so on. So we're nowhere near that level. But the question is why? And we started to hit on the idea of the Federal Reserve. We learned a few things that some people have never heard before. The Federal Reserve Bank is not necessarily a government agency. It's actually private central banks throughout the United States. And we also learned that the United States, the definition is a corporation. And we kind of looked at some of the different nuances of how that relationship works within the framework of our monetary system. So what I'd like to do here, just to kind of really redefine, I didn't want to oversimplify the Fed by just saying, hey, they're not a government institution. I wanted to kind of educate the listener today a little more on the Federal Reserve System and how it works. So last week we talked about how the banking system works, right? So we talked about when you go into the bank, you hand them $1 million, they're going to actually lend out a majority of that, and they're only required to keep the 3% in the lower reserve. So if you were to go in and want your $1 million back, they're not going to be able to give it to you. And so they use your money essentially to lend out to other people, and then that interest that's generated, and then the fees, like on a mortgage loan that they give, the origination and so on, that's how banks make money, that fee income, that interest income, and then they pay you back for your $1 million that's sitting in a CD, 3 to 5%, while they're making 7%, up to 22, 25% on credit cards and loans. So that's how banks make money. We also talked about how, because of this fiat currency that's not backed by gold, but it's backed by the full faith of the US government, it is a debt-driven society. By having debt, we actually create loans, or actually create money from loans, I should say. We'd like to know what you think. If you want to give us a call this week on the show, number 772-340-1590. That's 772-340-1590. So before we get into the Federal Reserve and start talking about their function, we talked about the banks last week. Before we get into the Federal Reserve, what do you think? I mean, have you been to the bank recently? Have you had any problems getting money out? What do you think? Is it looking okay, or are you starting to see any signs of problems, at least at the consumer level?
Not right now, not that much. I mean, it first affected us, of course, in COVID because of the change of hours.
Yep.
Now that was very difficult to be able to obtain your money. Other than that, I think that is actually being better in that regard.
Yep.
Now, sometimes we do have difficulty because, again, it seems like the actual staff is not all there as
Yep.
it was before COVID.
Yeah, so
So-
basically we've got mainly it was due to staffing, it was due to hours and so forth. There were some challenges in accessing money or whatnot, but now it's a little bit back on track, it seems. So that's a good feeling. So let's talk about the Federal Reserve. Let's talk about how they function in this financial system that we have. So the Federal Reserve System, often shortened to just be referred to as the Fed, so I'll use that phrase so you keep up with it. It's the central banking system of the United States. It was created in December the 23rd, 1913, and it was with the enactment of the Federal Reserve Act after a series of financial collapses. Now, particularly, there was a panic in 1907, a run on the banks, which led to this kind of desire to control the monetary system throughout the country in order to alleviate some of these financial crises that would just show up periodically. And so over the years, other events like the Great Depression in the 1930s, the Great Recession, of course, we talked about in the 2000s, have kind of led to the expansion of the roles and responsibilities of the Federal Reserve. But let's go to the core of what their objectives are. What did Congress ask the Federal Reserve to do, right? So the Federal Reserve Act, the key objectives in their monetary policy was to maximize employment, stabilize prices, and moderate long-term interest rates. That's their three tasks, if you would want to call it that. Now, the first two objectives are often referred to as the Federal Reserve's dual mandate, right? So basically, its duties have expanded over the years. Currently, also supervising and regulating banks is now part of their day-to-day operations, and they help to maintain the financial stability of the system and provide financial services to depository institutions, U.S. government, foreign official institutions. Also, the Fed conducts research into the economy and provides numerous publications such as the Beige Book and the Fed database. Now, we had talked about how much money is in the Fed, and we talked about how some people in office are like, hey, we need to audit the Fed, audit the Fed. Well, believe it or not, the Fed does release an audit. It's a third-party audit, and it comes out every year. If you go to the Federal Reserve website, you can actually find it there. So have faith. There's a good system that's set up here. but we're going to look at some of the positives and negatives about it.
So it's not all redacted. I mean, you can actually read it.
You can actually read it. It's going to talk about how many certificates of gold they have. It's going to talk about their assets and whatnot. And one of the things that people don't really understand is how the layering system works for the Federal Reserve. So for instance, it's composed of several layers. It's governed by a presidentially appointed board of governors. That's what they're called, the Board of Governors, which is called the Federal Reserve Board. So this is 12 regional reserve banks in the United States. They're located in cities throughout the nation, and they regulate and oversee privately owned commercial banks. So we have these 12 people. They're appointed by the president. So you do get some representation here, at least in that respect. Nationally chartered commercial banks are required to hold stock in and can elect some board members of the Federal Reserve Bank in their region. So what you have basically is the banking system and the government kind of joining hands together and meeting in the middle. There's also something called the FOMC, which stands for the Federal Open Market Committee, and they set the monetary policy by adjusting the target for the federal funds rate. We hit on this last week. When the banks borrow money from the Federal Reserve, it's at such and such rate, then the banks mark it up. So this influences the market rates generally through the monetary transmission mechanism, and it helps to turn on activity and turn it off in the U.S. economy. So basically the Fed it's outside of the U.S. government, but it has a direct effect on the financial system. And while they can set long-term interest rates, they cannot dictate policy to the U.S. government. So that's the very important separation there. So the question that people have is the Fed doing what they're supposed to? And some may see the Fed as an organization that screws up the government policies that they make. So that, the government screws things up, the Fed's standing by to try to fix it and work it out. So these are some of the things that have been talked about recently, especially.
So they cannot change the banking laws to make the banks more responsible.
Right.
They can only regulate the laws that already exist. They can help to grow and shrink the economy with how much money is injected into the system, but they cannot organically stimulate growth or reduce the national debt.
Exactly. So how are they doing? I mean, how are they doing right now? What's your research showing us here?
So when the politicians created a massive bubble after COVID by injecting $2 trillion into the economy, which caused the highest inflation ever to like over 7% in 2021, the Fed had to jack up interest rates by triple to beat it. It is now down to 3.1% with a target of 2%.
Wow.
On its face, the economy is doing well, but are these numbers manufactured?
That's a good question. Are they manufactured? So basically, we had this injection of cash go into the economy, $2 trillion to stimulate it. And did it stimulate it? Yeah, it probably brought us out of COVID. But of course, the unintended effect maybe was it caused our inflation to go to its highest level ever. So 7%. And now they've been working hard, the Fed has, to cut that down. So this is kind of where the fixing of the government mistakes kicks in.
Mm-hmm.
So they've been trying to get it back down to the 2%, which is their target. And we're right now at 3.1. So on its face, how's the economy doing? We're not sure. It looks like it's doing well on paper, but is that all manufactured? What are the unemployment numbers looking like?
So they're low. That is based on how many unemployment benefits are filled. So they may not reflect the real jobs numbers. Additionally, many companies started hiring employees back again after COVID.
I see.
Yeah, we now have a record number of Americans who are homeless due to the cost of housing and cost of living. The Fed Chair Jerome Powell, a 60 Minutes interview, basically said he does not see an end to those high prices despite the drop in inflation.
Right.
Also, they may begin bringing rates down in the summer. 5 major bank closures in 2023, and we're seeing some on the edge and shrinking.
Gotcha.
So what caused the failures?
Well, it's a great question. If we look at where we are now, you hit on two very important things on the research. So if we're basing the numbers of employment on how many unemployment requests have been filed, okay, so, but does that really reflect what the real numbers are?
Yeah, how many people are out of the system totally?
Yeah, and that's an important question. And yes, we do see the job numbers coming back up, But this is just businesses rehiring the people that have been laid off during COVID. So I'm thinking we're looking at manufactured numbers. We're not looking at real numbers. And you hit on the most important thing, which is Jerome Powell is saying that he doesn't see an end to the high prices. And we have a record number of Americans literally on the street. So the cost of living has put people on the street, and the cost of housing in particular. And so are these manufactured? I would say they are. So interesting thoughts.
And I think a lot of homeless people also don't even know where to start. They don't even know how nowadays you're supposed to search for jobs either. They don't know that the state actually has offices that you can go to them for free, and they'll assist you create resumes. They'll assist you to look for jobs. They actually
right.
let you use computers for as long as you need them.
And where can they find these? We're here in the state of Florida for our international and national listeners. So
That state actually has different offices. They have it in Palm Beach and Belle Glade, Fort Pierce. There are different offices that they can actually go to them.
okay, so if you're out there right now, you're here in the Treasure Coast area, you're unemployed, you're looking for work, the state does have these offices where you can go in. They'll help you build a resume. They'll help you get you into the system to find a job, and even help with placement. So reach out to that resource as it's there for you. So the question you left me with was, what caused the failures? I think now's a good time to go to a commercial. When we come back, we're going to hit on that. In the meantime, give us a call, 772-340-1590. If you'd like to give us your input, 772-340-1590.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, or right now to schedule your free consultation so that you can join the old club. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
This is WPSL Port Saint Lucie, the talk of the Treasure Coast.
All right, and welcome back to the Sun Palm Financial Broadcast. We're coming to you live from the Treasure Coast, being picked up globally. We're talking about the situation with our financial institutions here in the United States. Are we stable? You know, we also talked about the Feds and how the Fed applies monetary policy to essentially prop up the economy or to make it get back on track. And we looked at a little bit about how they do this and that relationship they have. But we're still seeing in 2023, we saw some major bank failures, 5 banks. So the question is, what caused it?
So overextension of credit without enough in reserves, terrible management, too much focus on equity, inclusion, and ESG instead of responsibility to the shareholders.
That's for sure.
And commercial real estate.
Yeah, overextension of credit without enough in reserves. I'm going to hit on that in just a minute, but she also mentioned a lot of these banks right now and companies in general, we're seeing a lot of focus on equity, inclusion, ESG. These are sort of, I don't know, for lack of better terms, it's maybe virtue signaling. And by doing this virtue signaling, really what they're doing is they're placing some of their emphasis and focus on the wrong things, and it's causing a lack of responsibility to the shareholders, the bottom line, hardcore, old school business tactics, right? Mm-hmm. You need to, my old grandpa Jimmy used to say it this way. He said, if your outgo is more than your income, it will be your downfall. Simple stuff, right? And really, that's a good point. So if they're extending too much credit, and they don't have enough in reserves, and these banks start to take a hit, people aren't able to pay their loans, people foreclose and whatnot, there's not enough in reserves to cover those losses, then we're going to have a major problem. And so one of these banks specifically, we had just talked about them, Silicon Valley Bank, they really got nailed in this particular area. So their responsibility, and this is not just my opinion, they were called before, Senate hearings about their failure. There was just not enough set aside as a hedge for any losses that would happen. And when FTX crypto, this exchange situation happened, that was a massive hit. We're talking about the second largest fraud, essentially, in the history of the United States, right behind Bernie Madoff. And it was pulled off by a kid and his kids, his friends, right? And it makes you just, honestly, it makes me mad. As a person that advises people on their money for a living, we have a lot of people that came to us, what about crypto? What about crypto? And I actually had a close friend, I won't mention his name on the air, but he'll thank me later. If you want to call in, that's okay, you can. But he called me, he said, hey, I'm going to invest in this thing called FTX. And I said, okay, let's talk about it. And he says, well, it's an exchange. It's not even crypto. It's where crypto is traded. And he gave me this whole pitch and so forth. And of course, I'm already a little bit savvy on the whole crypto idea. So I was paying attention. I said, well, what due diligence have you done on this company? Oh, well, everybody's doing it and all the celebrities are doing commercials about it. I said, but what due diligence have you done on this company? So we did some due diligence. We're not happy with what we were seeing. And I said, you know what? That is a speculative investment at best. So at my level, I'm seeing this. I can't imagine or believe that people at these higher levels couldn't see that catastrophe happening. And so my good friend thanks me to this day for saving his shirt on that one.
So his name wasn't next to FTX Arena?
No, it was not. But so it's very important that these banks have enough in reserves to, absorb losses. They also, need to focus on their shareholders, not trying to look good to the world for saving the world. Somebody said to me, what caused the bank failures? And I said, well, climate change did. Since that's the cause of everything bad these days. How dare you? So anyway, let's move on. So anyway, I'm going to give you something today on my research that no one anywhere, I have scoured the news to answer the question, what caused those last bank failures? And it's not just those elements that we talked about, but what also set up several others that have them teetering in 2024. I did a deep dive in this topic because having been a banker back in 2008, I remember I was in the seat when these things were going down. And Sandra, you were too.
Yes.
What did you see back then?
Well,
bad management, all the same stuff, or what?
yes.
Washington Mutual, I think they had made a big purchase in some of the big mortgage blocks. I think Wachovia Bank did too.
And because of that, a lot of stores, actually branches started to close.
Yep.
So there were a lot of people
Left
without a job.
Yeah.
Because of it.
Well, and we're starting to see some of that as well. Huntington Bank closing a bunch of branches by March. I think it was a few others that are. But the one thing that no one, not one media organization has touched, not one. Trust me, I've looked for it. And I went and I did a deep dive myself, and I found this one piece of information that no one's talking about. So you're going to hear it for the first time right here of what I think aided to the responsibility of this situation. Here it goes. You ready? Effective for the reserve maintenance period. This is a direct quote from the Federal Reserve. So effective for the reserve maintenance period beginning March 26, 2020, the 10% required reserve ratio and net transaction deposits above the low reserve tranche level was reduced to 0%. Then the second part is the 3% reserve ratio against net transaction deposits, and the low reserve tranche was reduced to 0%. So the action reduced required reserves by an estimated $200 billion. I sounded like Dr. Evil on that one. So what am I saying? I did a deep dive. I'm looking at the Federal Reserve. After COVID happened, there was some concern that we'd have lots of problems, banks wouldn't want to lend and so forth. So they made it really cheap for them to lend. And they basically said, you don't have to keep any money in reserves. 0% when normally they're supposed to be 10, and 3% in the reserve ratio on the lower tranche. This is unbelievable. So all these banks basically did not have to keep the required reserves that have been established for a really long time. Here we are less than 4 years later, and we have bank failures happening. And now we have a correction starting to be talked about and already being put forth by our legislators about banks having to keep more in reserves. So this is the problem. If you say to a bank, and keep in mind, this is monetary, I guess you can't really call it policy because it's not carried out by our legislators, but it's the policy of the Federal Reserve Bank. These guys have basically said, you have all this money in the bank, you don't have to keep a percentage in reserves. You can just go ahead and lend out as much as you need. That's really what it is. So and we saw this in the 2008 crisis. So the cheaper that it is to have access to money, and the more you can lend out without having to keep in reserves, you'd have to be a fool to do this, but many banks went all in.
Well, that's a prescription for disaster.
Absolutely. Absolutely. And so with that said, and I can't believe no one else has caught this or is talking about it. Nobody. So with that said, it's pushed us to recession. It's pushed us to a situation where we're looking into the future and we're saying, okay, how bad can this get? So we're looking at possibly major crisis coming up 2024 when it comes to the commercial real estate stuff. So what's that going to look like? I'll tell you in just a minute. But first, I also want you to understand that when these banks started collapsing, we talked about how the Fed injected, billions of dollars into the system to keep some alive. We also talked about how the big banks also either absorbed them or bailed them out with their own, of course. And I talked about how this works. So for instance, if I'm big bank and you're little bank and you're struggling and I give you money, it's not because I'm being nice. Your stock is at an all-time low because you're struggling. I inject cash into your bank with the caveat that I own a percentage of your stock. So once I inject the cash, it's like a self-fulfilled prophecy. Your stock price is going to skyrocket because now you're saved. And then I just made a bunch of money as a big bank. So what we're doing now is we're starting to see super banks being created. The smaller ones going away or being absorbed by the bigger banks or being controlled by the bigger banks through purchases, mergers, and whatnot. And we're also seeing this on the credit side. So for instance, the other day I go into my credit card and I see that one big company, I won't mention their name, I don't know if it's been publicly released, but one big credit card company has just been purchased by an even bigger credit card company. So now they have this huge market share in the credit card arena. It's not a monopoly, but it feels like it when you look at it. So pretty big stuff here.
That also happens with your loans. How suddenly you just get an actual statement that your loan has been sold to a bigger bank.
That's right. Yeah, it's a good point. How many of you have had that where you have the, I remember I had a loan once. It was purchased by another bank 3 different times. I didn't even know who the heck I was supposed to be paying. So kind of a weird situation when we see these super banks being created. So we're about to go to the break, but when we come back, we're going to talk about 2024, what's the rest of what the first quarter is looking like and what the rest of the year is looking like, and what are some concerns, the biggest one being commercial real estate bubble that could potentially happen. We'll see you on the break.
Feel free, give us a call, 772-340-1590, 772-340-1590. Give Sandra, Liliana, and Dave a call.
Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them? Do you dare believe? Are you willing to work for them, strive hard, to never give up until they are realized? Are your dreams worth chasing? Well, if they are, welcome to Sun Palm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
This is WPSL Port Saint Lucie, the talk of the Treasure Coast.
Welcome back to the Sun Palm Financial broadcast. We're here on the Treasure Coast of Florida and being broadcast worldwide. Topic of the day is how stable is the U.S. banking system right now? What challenges do we see in the future? So we've hit on several different, components of this. And one of the things that we are looking at is the real estate bubble when it comes to the commercial side of things. So first, let's talk about how that works, right? Once you understand how it works, you can maybe see the problem. So typically, let's just say I'm a commercial real estate investor. I'm getting what commonly referred to in our business as a hard money loan. So I want to build or purchase this big building, right? And I want to have a bunch of people occupy it on my 10 floors. The top 2 floors will be, law offices. The middle floors will be financial services. And then the bottom will be, companies for their cubicle world, right? So how does this work? So conventional lending institutions often require a down payment, usually between 15 to 35%, depending on the specific lender. And in some cases, certain loans can be backed by the U.S. government, the Small Business Administration. They call that the SBA. And so those may be available with down payments as low as 10%. Now, commercial real estate loans are frequently offered with repayment terms ranging from 5 to 10 years or less in some cases. And though some of the loans are also available to extend out to 25 years in certain cases, such as the SBA loans, that's kind of a rare thing. Now, the way this works is the tenants pay the mortgage and the expenses that are covered through rent. So basically the renters of these buildings, they pay the rent, and that rent covers the mortgage payment. It covers the taxes, the insurance, and then of course it makes the owners a lot of money. If you can imagine, you've got this huge building, for instance, and it's full of occupants. That's every commercial building owner's greatest fantasy. We want to have the whole building full, and we're collecting rent and so forth. So, but what's happening right now is that taxes have gone up, they've skyrocketed. Insurance has gone up, it's skyrocketed, and they've hung in there because it's still enough of a margin that they're making a profit, or at least breaking even. But there are a lot of studies that are happening right now that are looking at this, and they're saying, wow, this is a potential for catastrophe, because a lot of these loans are coming up for adjustment time. So once that adjustment time happens, guess what? That rate will go through the roof. And now we have tenants that are paying their rent, and it's not going to cover the taxes, the mortgage and the insurance. Similar to what's happening with a lot of people right now in the residential side. And so with that happening, that's a real problem. Now, not only that, but we have the COVID effect. So what's going on with the COVID effect? Well, when COVID happened, Everything was shut down. Everybody got to work from home. And what ends up happening then is people didn't want to come back to work because of health concerns and whatnot. And all of these companies started to say, you know what, we may not need to renew our lease this year. We may not need to do it. We're now set up, and we, for 2 years, been fully operational, having our staff work from home. And by not having to have these rents for commercial real estate, we're saving all this money. We don't want to come back to the office. That's a terrible catastrophe waiting to happen. And the other thing that kind of plays into this is there are some companies who have long-term leases that they can't get out of. And they, even if they wanted to renegotiate them, they may not be able to because the landlord has to pay all those expenses now. And they're like, no, you're going to continue to pay. And so companies are literally threatening their staff to come back into work or be fired. There are several that have done this now. I won't mention their names because I don't want to give them bad press, but major companies. And there's one tech company that's known for solutions for business. And these guys have told they've just basically said, if you don't come into work, you're gone. Your job is gone. And so on one hand, I understand their predicament. It's a big one. They have all this commercial space that they're paying for, so they want their employees to come in. But at the same token, it doesn't look good for the company, but what's to be done? So this could be a problem coming up here 2024 and rolling into the following year, when a lot of these building owners basically do what happened in 08. They're going to say, hey, we're walking. You can have the building. And the banking industry had to learn to be landlords. They were in the lending business, not in the property business. But after 08 in the residential sphere, they learned how to be real estate people, how to take these homes, get them back in shape and sell them. But that's because everyone needs a place to live and there's not enough housing. But with commercial buildings, then what? If you have these big empty buildings and nobody's coming back to them, and doesn't seem to be a big desire for them, we could be left with a bucket full of holes here. And on one hand, as an investor, I love Warren Buffett, his quote here. He said, when people get greedy, I get scared. He said, but when people get scared, I get greedy. So this might be a great opportunity if you're an investor to jump on some commercial real estate, but should you? Because there's a big risk that you'll buy that building at a great discount, or you'll invest in it and you may not make anything. You might have just bought someone else's problem and now you've made it your own. So this is some of the things that we're looking at. We might just see another 08, but in the commercial sphere. So kind of scary. So what's the fix to this? How do we fix it? Well, one of the things that banks could do is they could adjust their rates. So it's better to have something coming in than nothing coming in, right? So if the rates go crazy, they might be able to renegotiate those terms. It's just like what happened in 08. We had people that, couldn't pay it when their adjustable rate mortgage adjusted. And banks got to the point where they're like, well, let's go ahead and renegotiate those. That way the money keeps coming in. We're not left with a bunch of real estate. So that could be the case. But then the thing is, if they adjust the rates, are they going to see occupancy? And that's the real question. And it's a big one. So I'd like to know what you have to say about it. If you want to give us a call in, 772-340-1590. So as we're looking towards 2024, there's a potential for, this real problem happening in a lot of these banks. We're going to be holding these loans. They don't have enough in the reserve, some of them, because they took the Fed's offer. And so is your money safe in the bank? What do you think, Sandra?
Well, one of the things that we have to keep in mind is to not overextend your FDIC coverage.
Right.
If you have less than $250,000 in an account at a U.S. bank insured by the FDIC, then you almost certainly have nothing to worry about. Joint accounts are insured up to $500,000.
How
Now,
about our international banks, Europe and those guys?
they operate similar programs in Switzerland up to 100,000 Swiss francs,
Okay.
like 108,000 pretty much,
Okay.
is insured per depositor. It would be good for you to check the rating for your bank, see where they stand. Consider maybe a credit union. They tend to be more physically responsible. They operate on a similar but different set of rules.
Yeah, that's a good point. When you're talking about the difference between banks and credit unions, a lot of folks don't understand the difference. The biggest difference is a bank is a for-profit organization, and technically, if you want to put it this way, a credit union is a non-profit. It's a not-for-profit organization. And the biggest difference there is credit unions, of course, are responsible mainly to their members. Their members are the shareholders versus shareholders at a bank. So this is why I don't know, it just tends to be a greater emphasis and focus on taking care of the members to where people stay and don't go elsewhere versus trying to grow rapidly like the banks do, which can get them in trouble if they make the wrong decisions and policies.
Okay, I've got a question. If
Sure.
going back to the 250,000, in a bank,
Yep.
if your bank is failing and you want to get that money out, how long a period of time are you talking about before you get your money?
Such a great question. If your money's in a bank and the bank fails and you want to access whatever money you had in there up to 250,000, it's going to be a minute. It's actually not it's not a situation. I mean, think about this. This is the Federal Deposit Insurance Corporation, the FDIC, which is a government entity, or at least an insurer of the government entity. Does anything in the government move quickly? No, it doesn't. So you're going to have to go make that file, make that claim, and then it's going to take a good while before you access your funds.
Not only that, but when it becomes public, you know how everybody just runs to the bank to get their money, and that's why the bank has to stop them and take some time to be able to look at everything that they need to pay everybody, back. So
That's a good point. So yeah, when you have a run on the bank, it's not just going to be you trying to get your money. It's going to be all of their customers.
Yeah, it wasn't that first bank that went. It was the second one that I guess had the run on it.
That's
because of the first one.
Exactly. Yeah. So that's a really good point. So our engineer here has brought up a very important point that the first bank that got the biggest attention was Silicon Valley Bank. They went under on 3/10/2023, and right after that, Signature Bank of New York, people started to see this situation. They're like, oh my gosh, maybe I can't get my money out. So they did a run on the bank. And they're like, hey, I want my deposits. And of course, like we mentioned last week and a little bit this week, if they're only keeping so much of your money in reserves, they're not going to be able to pay it out. So they either have to get outside investors to throw them money to pay for this run on the bank, or they're going to go under. And that's what happened with Signature Bank of New York. So it's a really good point. So I guess the last part of the show here, if you're in a situation like right now, you've got your money in CDs, okay? And is it safe, and what should you do with it and so on? Well, first of all, as you know, most CDs are going to be for a period of time. So 1 year, 3 years, 5 years, and so forth. And of course, the longer you commit to leaving your money in there, so the bank can lend with it, obviously, the higher the interest rate they're going to pay. I would say that if you have your money in an account, you've got the FDIC insurance in there, and you don't want to take that hit for taking it out because you will pay a penalty to remove it early, then maybe it might be an idea to just kind of ride this one out. That's option one. Option two, you could take it out, take the hit, and throw it in an investment that can maybe get a little more return for you, and over time will pay you back what you took as a hit. So it's going to be important to know how much of a hit you're taking, really. And you could do that. But the next question, of course, would be, all right, well, what would be the other investment? Would it be real estate? Well, take my money out and buy a house and turn it into rent? rent's pretty high, but guess what? We talked about a couple shows back. So is the cost of owning a house. Taxes and insurance are through the roof. We talked about the 5 mortgages. We talked about the mortgage, taxes, insurance, the utilities, which are now a fortune, assuming that the landlord is paying them, and then HOA, if you have an HOA. So 5 different people that you have to pay if you own a property. So that can get expensive. And right now with the desperation for people to have access to home ownership, it's a good time to sell. So
Also, keep in mind that sometimes with the CDs, you will not be able to actually get your money out, like Dave said, for a certain time frame. But there are some annuities that have what is called a base bonus,
Right.
which is way greater than the amount that you would actually be losing by taking your money early from a CD. So that's another thing that we could look into for them.
that's a good point. Sandra hit on something that is really awesome. We're starting to see a lot of in the insurance sphere is if you take your money out of the bank, you're taking a hit. Or if you take your money out of a brokerage account, stocks, bonds, mutual funds, you're taking a hit. On the insurance side of products, they have annuities that offer what's called a base bonus. So basically, if you show up and you've got $1 million, let's say, and you want to put it in this annuity, they'll give a base bonus of some of them anywhere between 20% or higher that they're going to automatically credit towards your accumulated value. So what does that mean? That means your $1 million would normally be, let's say, collecting 5% interest, right? Or higher. Actually, in some cases, if it's indexed properly, it could go much higher, somewhere in the 10 to 13% in some cases. Yep. And if you have it, this base bonus, they would not just give you that interest towards your $1 million. They would give an additional 20% of your $1 million would be accruing that interest. Now that 20% may not be yours, but you're getting the interest from it. So this is a creative way that some of these insurance organizations are dangling the golden carrot to get you to leave those situations that might be volatile or considered unstable, or if you're concerned. If you're interested in hearing about these, please reach out to us. We're at www.sunpalmfinancial.com. You can just shoot us an email or select a available date on our calendar to meet up with us. We'll be happy to look over your situation, give you a real honest feedback, and talk about ways that we might be able to help you out there. Because we've got lots of really great companies that we work with on the insurance side of things. And one thing I like to mention, and we're kind of coming here in the last 5 minutes or so, why insurance and how safe is that? Because if we're going to hit on the other problems and concerns, let's talk about how safe the insurance part of things is. Well, the way I like to do it is this. If you've got your money sitting in a bank and you're concerned about it, what are you protected by? The FDIC, Federal Deposit Insurance Corporation. So if the federal government and some of these other entities are using insurance to protect your assets, well, it kind of makes sense that you would just fast track right to the source for your protection. These insurance companies, they operate under a different set of rules. They have vast amounts of money behind them because most people, when it comes to insurance products like homeowners insurance, car insurance, and these kinds of things, they pay most of their premium up front and it's coming in every month. So there's big money sitting there to kind of be a huge buffer. And really, when you're talking about insurance companies, one of the things you have to think about is when you're putting your money into an insurance product, you have the stability of the insurance company that's backing it, and you also don't have the volatility of the market. So, for instance, these things that we're talking about here that could really have a major effect on the stock market, if you have your money in a fixed annuity or a fixed indexed annuity, when the market's good, you're getting those gains in the indexed ones. When the market drops and it crashes, your principal is safe because it doesn't have it doesn't go below the floor, which obviously. So there's probably one of the safest places to put your money.
So you either gain or you just break even.
Exactly.
You don't lose anything.
Right. And so it's a kind of a win-win in that regard. The other thing is that, with insurance, you've got this these mechanisms that are in place that are, for instance, they have riders is what they're called, where if you have a situation where you end up in the hospital, well, guess what? You can access your money early without penalty with that rider. You have death benefit riders. You also have riders where when you pass away, the money can go right to your designated beneficiary and it won't be taxed to death like it would be for an investment and so forth. So there's some really great products over there. We're doing a lot of this type of business lately, so important to mention it to our listeners. So definitely some things to look at as we go into the future. And as you kind of look at 2024 and you start to see the signs that concern you, don't wait. You don't want to be that person that does the run on the bank. You want to have a well thought out plan, at least, even if you don't want to commit to anything yet. I would say reach out, like I said, sunpalmfinancial.com, reach out, at least get a look at what we could do for you on some of these areas. And then as it starts to kind of look shady or scary, definitely you already have a plan in motion. But keep in mind that some of these rates that are being offered by these annuities and so forth, they do change. So if you have a really good opportunity, I say jump on it, don't wait, because by the time they, everyone makes the run on the bank and wants to do something with the money, well, they're not gonna, may not have that rate that's available at that time or that base bonus that we were talking about. So just a couple of thoughts there. Well, I appreciate you for tuning in to the Sun Palm Financial broadcast here. And like always, we're here for you. If you want to reach out to us, www.sunpalmfinancial.com. And next week, go ahead and tune in. We're going to be hitting on a couple new topics, and we may have some guests coming up in future shows as our subject matter experts to join us. We're going to be looking at the real estate market. Should you buy? Should you sell? Jerome Powell talked about his rates. The Fed level will be actually going down this summer, so be on the lookout.
All right, and how do folks get in touch with you?
They can reach us at sunpalmfinancial.com, and our phone number will be listed there. Email will be there. All our contact information. We look forward to hearing from you.
All right, see you next week. You've been listening to the Sun Palm Financial broadcast right here on WPSL, Port St. Lucie, Talk of the Treasure Coast, webcaster to the world.